This time, in this video, we are looking at what is private equity. So first of all, we'll give an overview of what private equity is. As private equity is medium to long-term finance provided in return for an equity stake in a company which is not publicly listed on the stock market. So in contrast with publicly listed companies, private equity managers will work alongside the company management team in order to enhance the value in the business. So capital will be used to make acquisitions, expand working capital, and bolster and solidify a balance sheet. So private equity firms will typically hold investments for between 4 and 7 years, before which time they will look to exit or sell their stake. So this can be done on the stock market or to a corporate buyer or another investor. So a private equity fund has limited partners and general partners. Now the limited partners are the external investors in a private equity fund, and their total liability is limited to the capital they invest. But the person to manage the fund is a general partner, and they manage the fund's portfolio. So this means that they have full liability. So there are some advantages and disadvantages with private equity. So private equity does offer several advantages to companies and to startups. So private equity funds can come into the business with new ideas and perhaps new managers to help the business grow and become more profitable. Private equity can also offer growth strategies to companies away from the scrutiny of the public market. Now this is because companies on the public market have to publish quarterly earnings, and this reduces the time frame to turn a company around. There are also unique challenges associated with private equity though. So it can be difficult to liquidate holdings in private equity because a firm has to actually search for a buyer in order to make a sale. This sale is then determined through negotiations rather than market forces like the stock market. The ultimate goal in private equity is also to make a company worth more than it was originally. So this means that the workforce, the business, and long-term success can all be secondary to this goal, and therefore there can be ruthlessness involved. So the business can also continue to struggle after the sale, despite the fact that the private equity firm have profited. So how does private equity work? Now, private equity firms raise money from investors, and these investors might be hedge funds or wealthy individuals to fund its acquisitions. It then restructures the acquired firms and attempts to resell at a higher value. Now, there are a number of different ways of private equity funding, and these include growth capital, which is usually a minority investment in a relatively mature company that's looking for capital to either expand or restructure operations. It might want to enter new markets and diversify, or finance a significant acquisition without a change of control of the business. There's also something called leveraged buyouts. Now this involves buying out a company completely and reselling it for a profit to an interested party, or conducting an IPO, as we looked at in the last video of what is the stock market. Now a private equity firm will identify a target and create a special purpose vehicle, an SPV, for funding the takeover. Firms will then use a combination of debt and equity to finance the transaction, and the debt financing will be transferred to the acquired company's balance sheet for tax benefits. Now the expectation with leveraged buyouts is that the return generated on the acquisition will more than outweigh the interest paid on the debt. So this makes it a good way to experience high returns whilst only risking small amounts of capital. Considering the buyer will put a large amount of debt on the company, it is critical that the company is stable and will be able to pay off its future debt. Now the target should therefore have a strong cash flow business and have low debt levels. There's also venture capital. Now this is one of the most well-known ones, and it's a form of private equity in which investors provide capital to entrepreneurs who have businesses with high growth potential. Now this is invested in exchange for equity or an ownership stake in those companies. So finally, we need to look at how do private equity firms make money. Now the primary source of revenue for private equity firms is management fees. So for example, most firms charge a 2% management fee annually on assets under management and require 20% of the profits gained from the sale of a company. So if we give a hypothetical example to show how this works. So say there is a private equity firm which raises a £900 million fund. Now 860 million has come from the limited partners, who as we mentioned before are the external investors, and then 40 million, which is 5%, has come from the general partner who manages the fund. Now, the general partner will then invest all the capital into acquiring companies, and after a few years, they exit these portfolio companies for a 2.5 billion total. Now, this means that the limited partners will get back their 860 million, and this is returning their capital investment, and then the remaining 1.64 billion will be divided up 80% to the limited partners and then 20% to the general partner. So this means that the limited partners will get £1.312 billion on top of the 860 million that they've got back from their original capital investment. The general partner will get 328 million. Now, this is an 8.2 times return from their initial investment of 40 million, which shows how the general partner and the limited partners earn money. So thank you for watching this video. If you look at my description, I have a link to my website where we have the opportunity to get a free share. But thank you for watching and see you soon. Bye.